So blended finance is an approach for philanthropic capital to get catalyzed into impact investing. I think that is probably the best way of describing it. So the underlying idea is that there's already a pool of capital, commercial capital, that is seeking to invest in Africa, but that there's even more money in the philanthropic pool. And blended finance is how you create an investment vehicle, a structure that allows the commercial capital to bring in the philanthropic capital and collect that money to invest into impact investing or regions which may be underserved in terms of investment capital. So that is the overall idea behind blended finance. Now, how you get involved in it is normally when you're trying to satisfy a need. You've got a problem where you've got investments that are slightly higher risk than usual in geographies that people normally would not touch. You try to find the stakeholders and get them around the table to figure out how you can blend the finance, structure a vehicle that makes it comfortable for everyone to actually make that investment. And that's normally the genesis of a blended finance vehicle. And from my personal experience, I'd say the agriculture sector is one that stands out. So Africa's agriculture is underdeveloped. Our yields are below the yields are achieved in the rest of the world. The value chains aren't as developed as other parts of the world. So that means that by definition, investing in Africa without a blended finance vehicle is likely to result in lower than expected returns. So it's a perfect opportunity to secure philanthropic capital, which is seeking to improve the lives of smallholder farmers, for instance, and blend that with commercial capital that wants to make a financial return. So, a percentage of philanthropic capital with a commercial capital then allows fund managers like myself to deploy capital into the agriculture sector in Africa, keeping both the philanthropy section and the commercial guys happy with the returns that they're getting, and also happy with the impact that they're making in the market and in the lives of the farmers. So the biggest challenge, obviously, is that you've got different types of investors with different interests. The commercial investors primarily want a financial return. The philanthropic investors primarily want to have a positive impact in the lives of people. And their interests are so deeply seated that when you combine the capital and you try to please both masters, you can often end up in a situation where neither party is happy. So this is one of the biggest challenges. The second challenge is one that I describe as being linked to origination bias. So if a blended finance vehicle is started by an NGO or a donor, they'll normally seek to control it and drive it more towards the impact side, normally to the detriment of the financial return side. Similarly, if a commercial investor starts the blended finance vehicle, they'll be more focused on financial return than they would be on impact. So again, they might find themselves in a situation where they cannot attract the other party because there's too much of a leaning or a bias towards one side or the other. So these are some of the risks. And then folks like myself who manage these blended finance vehicles are often in a situation where you have to manage these conflicting needs. But that's our job. We try to make it work and we try to achieve the impact and the return and keep everyone happy.